Good morning, I'm Vandita Shivle and I'm here to take your mutual fund queries. The first query is coming from Kumar. Now, what he wants me to help him with is a good balance and a debt fund. He also wants to understand what are balance funds and what's the purpose of debt funds. Alright, so Kumar and viewers, please understand that if you look at the mutual fund classifications, right? They're broadly into three categories. You have equity funds. The main aim of equity funds is to create wealth, right? So if you're looking for wealth creation, you go for equity funds with a time horizon of over 5 years, at least 5 years or above 5 years, right? Now, the next is debt funds. Debt funds is for your contingency needs, and also debt funds is for giving stability in your portfolio. The kind of returns you can expect from debt funds, they are much lesser compared to equity funds, of course, because the risk is comparatively lesser in debt fund compared to equity funds. So definitely the kind of returns you can expect from debt funds is a little lesser than equity funds. And the third category is hybrid funds, where you will have a mix of both debt and equity funds. Let's try to understand that in detail now. And now you need to understand there are two kinds of assets: single assets and multiple assets. And mutual fund is also categorized in two ways. One is your single asset funds and another is your multiple asset funds. Now, single asset funds are like when you are into single asset class. You have equity funds, equity diversified funds, you have fixed income funds, you have gold as an asset class, gold funds you invest in, you have international funds. So that's single asset funds. When you are investing in only a single asset class. When you want to invest in multiple assets, there are categories for you, right? So you have there are two kinds of I could say there are two kinds of methodology that multiple assets follow. One is your tactical asset funds, and another is your strategic asset funds. That's the category, or I would say tactical asset allocation funds or strategic asset allocation funds. What does tactical asset allocation funds do? These are dynamic equity funds. The fund manager wants to benefit from the different market conditions. When the markets are dipping, he wants to benefit from other asset classes. So he will put more money in the other asset classes which are getting benefited from that market condition. So that's tactical asset allocation. This has a short-term view, right? And this is for people who are willing to take that kind of risk. Moving on, we have another category called strategic asset allocation funds, or here a fund manager has a longer term view. What he will do is he'll look at your risk appetite. He will look at your time horizon, and based on that, he will create a broad-based asset allocation. And according to that, he will be periodically, reviewing your portfolio, and he would be working on that thing, right? He would be reviewing the portfolio on a periodical basis. So that's and rebalancing the portfolio. That's a very important word that's relevant with the strategic asset allocation methodology. That's relevant to that. And it's very important that you need to understand where you are investing. For example, you want to be with tactical asset style of investing, then it's dynamic equity funds. You give that leverage to fund manager to play around a bit and benefit you from the market volatility. Moving on to strategic asset allocation, these are equity saving funds, these are balance funds as well. Then you have the different kinds of orientation. You have debt oriented balance funds, you have equity oriented balance funds. So based on that, it works like that. But balance funds, they really give you a good blend of equity and debt funds, debt exposure, and to be very frank. And when you're not sure how much you want to invest in debt, how much you want to invest in equity, it's always advisable to stay with debt funds. And also, sometimes you don't have allocation to debt at all. So this is a time when this is a category when you can actually stay invested with both debt and equity funds. So it's really good. It gives you it helps you to diversify in a better way. It gives you, and it benefits from diversification. So it's a very, very good category. Next, I would say, assume that you have an investment amount of 1 lakh, and you are investing, and the fund manager is taking 65,000 from that 1 lakh and putting in equity. 35,000 he is taking and putting in debt. Now, in a bullish market scenario, you can expect returns of 12%. In a bearish market scenario, you can expect returns of around 6%. So what this category will do is, it will benefit from both bullish and bearish scenario, right? In a bull market, the investment could give you or fetch you approximately 12% returns, uh, the amount from equity and the amount from debt, and that's a win-win scenario. That's why you want to stay with this category. Talking about the best funds, here the downside risk is definitely reduced. And talking about the funds that you could stay invested with, there are some of the best balanced funds that have given extraordinary returns in their category, and they also have a larger AUM. So that kind of safety remains when you invest in larger AUMs. So first is your HDFC Balance Fund. It is really a good fund. You can stay with that. Then you have L&T India Prudence Fund. That's another fund which has really done very well. The kind of returns they have given is over 15%, and these are not the absolute returns that I'm talking about. These are the rolling returns I'm talking about. Then you have ICICI Prudential Balance Fund. That's again a very good fund to be in. So these 3 funds you can stay invested with in case you want to be in this category. You can choose one of the fund and you can put your money in that via SIP, of course. So that's it. And when you talk about the balance fund, when you talk about another question on debt fund, which are the best debt funds, then I think that you can either choose L&T Low Duration Fund Growth Option Plan, or you can go with ICICI Prudential All Seasons Bond Fund. These are 2 good debt funds to stay with, and we really hope that your query was well answered. You can always write back to me. I've tried my level best to explain you, but because of the time I had to really reduce it. But let's now look at another query that's coming from Kuntal Das from Kolkata. What he says is that he's 42 years, that's his age. He has been investing in mutual funds for around 10 years now. It has been a quite long journey for him. He has learned a lot, he has unlearned a lot, and he did have to withdraw from funds a couple of times, but the major portion is intact. Now, he wished to utilize some of it for his daughter's higher education, that's 7 years from now, and keep the major portion for his retirement. Let's look at his investments and the funds now. He has been investing 60,000 rupees every month. His funds and their breakup are as follows. He has been investing 20,000 rupees per month in Parag Parikh Long-Term Equity Fund, 20,000 again per month in UTI Nifty Index Fund, 10,000 per month in UTI Nifty Next 50 Index Fund, and in HDFC Small Cap 10,000 rupees per month. Okay, so first things first, your SIP amount is quite sufficient here, Mr. Das. Number 2, after 7 years, let's assume that you need 50 lakhs for your daughter's education. So that is definitely possible with the kind of amount that you are investing. And after 18 years, that's your retirement would, if we assume that you're getting retired at the age of 60. So that's like 18 years from now, because you're 42. So you would be needing around 3 to 4 crore rupees. You can generate around 3 to 4 crore rupees with the current investment amount that you're having. So what does this mean? Why did I come to this conclusion? So I am assuming that the kind of returns you should be expecting from your portfolio on a conservative basis is around 12%, right? If the CAGR is 12%, you can definitely generate 3 to 4 crore rupees in the next 18 years. And 50 lakh rupees in the next 7 years. Now, the question which is important here is your current portfolio. So definitely, I would say that your current portfolio is fine. I mean, Parag Parikh long-term equity is a good bet. UTI Nifty Index Fund is a very good one, of course, because it benchmarks and it mirrors the index. So it's much safer. It's a passive investment strategy, and it's a good way to invest. You have another investment in UTI Nifty Next 50. So this is after Nifty 50, the next 50 stocks of this particular fund. So now, of course, the kind of returns they have given is quite impressive. The volatility or the risk that have been marginally higher compared to that of Nifty, but definitely the return to risk ratio is considerably better than that of Nifty 50 or Nifty Next 50, at least for a couple of periods. So I would stay invested with that one. It is little riskier already, so stay with that. The expense ratio is less, so definitely it's a good way to invest. But I have a problem here with your HDFC small cap fund. I don't think that you need to take that kind of exposure right now, because you have certain plans in mind. So instead of small cap, I would recommend you a multi cap. Why don't you invest in Kotak Standard multi cap instead of small cap? So that's the recommendation for you. If you're willing to take that kind of risk, higher risk, then definitely you can go ahead with that. But already you are into, you have taken Nifty Next 50 as a part of your portfolio, then I don't think you should be staying with a small cap fund. I assume that you can stay with a multi-cap fund, because that will give you, that will help you benefit across market caps. And you can stay with Kotak Standard multi-cap fund here. You can also, if you want, you can add a balance fund, because you do not have any debt exposure as of now. So one balance fund, what I have recommended to our previous viewer, you can stay with one of that fund. And definitely I think rest is good to go, and your fund selection otherwise looks fine. Viewers, it's very important that you invest right now. Why? Because you are not sure whether it is a good time to invest in equities, whether the markets will rally. These are the questions that will always come in our mind. But you need to understand, if you look at market cap to GDP ratio as of now, it stands around 78%, right? And before the global financial crisis, the market cap to GDP ratio was around, this global financial crisis was in the year 2008, right? And we saw that market cap to GDP ratio at that time was 151%. So 78 right now, 151 we were before 2008. So our market cap, there is a sufficient room for growth as a country. We might see that India will see a good bullish run going ahead. And also, we have a good vision. Currently our economic size is $2.09 trillion, right? The vision is to make it a $5 trillion economy. That's the vision of our Prime Minister. So why not benefit from the benefit from this kind of scenario, when we can see that there is a scope of improvement. So stay invested, prosper, and review your funds periodically, but stay with the right balance, stay with the right asset allocation. That's the word for me. And it's very important that you ask the right questions, even to your advisor, even to anyone you speak to. Ask them why should I put my money in this? Why? Because it's your hard-earned money. You have goals in place. So definitely review everything and then invest. That's the word coming in. But thank you so much for watching me today. Hope your queries were well answered. Thank you so much.